Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 5th, 2023. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, it was a bloody day on the markets here. The S&P 500 was down about 1.1%, somewhere in that general vicinity. So it should come as no surprise that when we look at our heat map here, the vast majority of stocks were lower here today. Remember when I was with you on Tuesday was a little bit of an oddball day where the markets were down that day, but there were actually more stocks up than down because it was Apple and Tesla that were leading the way lower that day with the larger market caps. So it was a little bit of a strange day. Today, we can't really classify it that way. Today was a broad-based decline, regardless of whether you were a mega cap or a mid cap or anything in between. Keep in mind that yesterday was the end of the Santa Claus rally, right? I brought that up on Tuesday as well, saying, expect perhaps one day of bullishness before Santa goes home to the North Pole. And so it's not a great sign that here we are one day after the Santa Claus rally and the markets are back to their bad old times just like they were earlier in December of last year. So not a great start here post Santa Claus rally as we get things going into 2023. So let's go through some of the information we have here. And you can see that once again, Apple was down. It was down over 1%. So that chart has gotten uglier and uglier as time has gone on. And remember, that's a little bit different because last year, Apple actually held up better than most mega cap tech-oriented companies. They were kind of the stalwart through it all, but eventually they come for even the good ones. It's kind of one of the things that we spent a lot of time on in my question and answer session earlier today, where I spent 3.5 hours with my premium members answering their questions. And one of the things that I wanted to remind them is that we've had it really good as dividend growth investors in the year 2022, but there could entirely be a delayed reaction that may require many of the high quality companies out there like your Pepsis and your Cokes and your Procter & Gamble's that will eventually get drugged down with the rest of the market if we have a continued bearish market environment into 2023, which is what I expect. So brace yourself. On the other side of that coin is the aspect of that, when stocks sell off aggressively, opportunities arise. And so if you have some dry powder sitting about when markets get chaotic, there are going to be people who vastly improve their financial situation as we come out of any bearish conditions that we might head into. I'm sure that if all of us were given an opportunity to go back to March of 2009 and scoop up value after value after value, we'd be happy to do so. So remember, that will happen again. When it happens precisely, of course, is unknowable, but it will happen just like night follows day. Bull markets follow bear markets, and it just takes some pain to get there. And we really haven't seen enough pain in the system yet, as I've been mentioning quite often. One of the peculiar elements of last year's slide is the fact that we really never had any true capitulation type of activity. We never saw the VIX spike above 40 like we have in so many other past economic skirmishes. So, we might very well require that moving forward. Not that that will be a fun thing for a lot of folks, but it is sometimes exactly what the market needs in order to finally flush out the weak hands and start advancing with stronger opportunities moving forward. But from my perspective, it seems like we have a long ways to go before we get there. So that's the bad news. But eventually we will, and opportunities will emerge. So keep your eyes open to that. And of course, those of you that are premium market scholars are welcome to follow along with my dividend growth investing class that I teach on Tuesday mornings, where we attempt to do just that. In fact, back during the COVID wipeout period in March of 2020, we were able to buy Nucor Steel and Caterpillar and McDonald's during that really ugly March period. And looking at those companies today, they've done extraordinarily well. So even in a mini skirmish like COVID, opportunities will emerge. But 2008, 2009, of course, was much more dramatic than COVID, and therefore we can have those types of opportunities again in the future. So let's keep our eyes open to that possibility out there. Right now, Apple is still in a little bit of a downslide. Microsoft was down about 3% here today. We had ServiceNow down about 7% in the tech space. Adobe was down 3.8%. This used to be a much bigger company as well. That's another one that was kind of a darling during the COVID period that's really just disappeared all of a sudden. We've got Nvidia down about 3.28% here today. So you can see a lot of really ugly action in the tech space, and with tech still being the biggest market cap area of the market, it's going to kind of dictate the chances of the market either doing well or not. And right now, we're in the not category because tech just cannot get out of its own way. You'll notice that Google was down over 2% here today. Amazon was down over 2%. Remember, Amazon was in the news overnight, coming out stating that they're going to be firing about 17,000 employees. And of course, we feel bad for the folks that are impacted by that. But in a way, that's part of this process. In order for us to break the back of inflation, we need to see lots of people get fired. I hate to say it, but that is the truth of the matter. It's one way to break the back of inflation. Eventually, that will happen, but it could take a long time to get there. We've seen massive layoff announcements now from Amazon and from Facebook and others, but there's still a long ways to go in that regard from my perspective. So brace yourself there, and hopefully you guys are all well financed from a personal perspective to be able to weather any sort of a storm with whatever happens with you and your own individual employment situations. Tesla was down yet again. Stop me if you've heard me before. It seems like Tesla's down nearly every single day here in recent months. It's down about 3% today and ended the day at about $110. So we didn't get any love from the mega cap tech-oriented areas that were out there. Of course, they weren't alone. There's plenty of other red that's on the screen. One of them that catches my eye was on Lindy. Those of you that watched the video that I presented to you on Tuesday will know that that was my bearish trade idea just 2 days ago, and it was down 3.5% today. In fact, I noticed it was down yesterday as well, even though the markets were up yesterday. And so that one is off to a really good start for us. Let me pop on over to the platform here real quick, and I'll show you, actually, let me pull up ticker symbol LIN. We're up 69% on that trade in just 2 days. What's interesting about it is we fell well short of the 100 likes that we request on Twitter this time around. And I always find it fascinating that a lot of times when I deliver my best trade ideas to you is the time when we have a lack of likes. I don't know if there's some sort of a correlation there or not, but when I was with you on Tuesday, I had shown you that 11 out of our 12 open trades that we had were winning trades, and I was hoping to use that as your pep talk in order to encourage you to click like once again to get us up and over 100, but it just didn't seem to work out that way this time around. You can see we only got to 89 of you clicking like. A lot of times, we're right there at like 102 or something like that, but this time we fell well short of that. So make sure you're getting back into that habit. If you appreciate longer form videos, then make sure you're doing your part by taking the 5 seconds out of your day to click like. Remember, it's completely free of charge for you to do so. So not a whole lot of excuses not to do that unless you're just unwilling to do it. But in the end, if you do prefer the shorter format video like I'm giving you here today, then I would encourage you to continue to not click like, because if we're below 100 likes, then we'll just do a quick 15-minute version of the video instead of a longer form 1-hour version of the video. I do understand that in this day and age, a lot of people prefer the shorter formats anyway. We seem to have a lack of willingness or desire to have our longer attention spans the way that previously may have been the case. It seems like short form video is kind of all the rage these days. So I certainly understand that as well. And of course, that makes it a lot easier for me. All right. A lot of times these videos take over 3 hours out of my day when I'm doing the long form video format. And so if you guys prefer the shorter form 15-minute version, then continue to not click like for me there on Twitter, and I'll continue to do these videos. On the other hand, if you like the longer form video that includes the trade application example, like that excellent bearish trade that I presented to you on LIN on Tuesday, then you'll want to get into that habit of clicking like. It's not hard to do. You can do it right here on our website while you're watching the video. You can do it by finding the tweet in question pinned at the top of my timeline on Twitter. And remember, you can also find it on our email. Give me a second. I'll show you where that is, because sometimes it's easier to show you than to describe it. So here's an example of the email that I sent out 2 days ago. And as you start scrolling lower on that email, there's this area here just above the orange bar that will show all these social media icons. And if you click on that one right there that says Twitter, it will take you to the tweet in question. That way it makes it nice and easy for you to find it. We don't want you having to leaf through a whole bunch of stuff to do something very simple. So there you can see, you would just come over here and you can see with your own eyes how many likes would have happened up until that point. And right now there were only 89 likes from my video on Tuesday. So you would just come here and click that heart button if you wanted to add your like to the count there. So again, I'm not here encouraging you to do one thing or the other. In the end, if you do prefer these shorter form videos, then it makes me happy as well, because I have to spend less time preparing for a trade application example and all that other stuff as well. So in the end, we'll let you guys decide going forward. But if you like the longer form ones and you want more trade application examples, then get into the habit of clicking like every single day. That really helps support David and I when we're doing these free videos. Remember, we don't get paid to do these videos, so it just cuts time out of our day, and we don't want to be talking to the wind, so to speak. So if we're spending valuable resources and time producing the videos, we want to make sure we're getting some benefit out of it as well. But anyway, back on track with the heat map. You'll notice here that on the heat map, there was only really one area that was more consistently green, and that was energy. So if you happen to have a few oil companies today that help bail you out, which is kind of the opposite of what we've been seeing more times than not in recent trading sessions. So today was a little bit of an opposite day where oil snapped back, but everything else started falling once again. You also saw a little bit of strength there in the communications area. Comcast was up. In fact, we just shut down a max gain swing trade on Comcast here in my swing trading class. You can see that Verizon was up, T-Mobile was up nicely as well. You've got Warner Bros up, so it seemed like a little bit of juice there in the communications area. Let's take a look at the actual breadth numbers here today. Back on the platform, popping on over here to the Market Watch tab, and I've got the S&P 500 pulled up in the Index Watch area, and you can see that today there were 119 companies that closed in the green, and that was good for about 23%. So again, the vast majority of stocks closed in the red today. It was a very obvious bearish day, and it wasn't just a function of market caps in today's session. Let's go ahead and pop on over here to the charts, and let's take a look here at the S&P 500 on chart 6D. I like to bring this chart up whenever we have a day that is either up or down over 1%. And today we were down over 1%. So for those of you that have known my routine of the trade application examples that I generally bring to your attention, you would have known that if I had done a trade application example for you today, it likely would have been a sold put trade. So there's plenty of opportunities out there. In fact, we talked about some of those opportunities in my 3.5-hour educational session for my premium members earlier today. But on the S&P 500 itself, you'll notice that this red bar did close down below this blue horizontal line, telling us that that was more than a 1% down day. And this is now our third 1% down day or more since December 22nd. It's not quite as consistent as what we were experiencing back in the fall, when it felt like nearly every day was a 1% down day. But then again, you never know when we start clicking back into that behavior. Right right now we've actually seen that the S&P 500 has done a good job basically just consolidating sideways through that Santa Claus rally time. But now that you don't have the Santa Claus rally support, it makes you wonder, are we destined to head lower once again? The VIX did go up today just ever so gently to 22, but it's actually a little surprising that the VIX wasn't up a lot more. With the markets down 1% today, oftentimes the VIX would be down significantly more. The VIX would be up significantly more than it was today. So the VIX, if you wanted to see what that looks like on the chart, was basically, let's see here, it was at 22.46 is where it ended, up about 45 cents or thereabouts basis points, however you want to say that when you're talking about a percentage vehicle like the VIX. But the point is that wasn't a very big move in the VIX for what was a pretty strong sell-off in the markets at large. Let's go ahead and now take a look here at our foregrid, get a sense of how today may have changed our postures. And oddly enough, we did get some posture changes today. The S&P 500 went to a weakly bullish posture, not a strongly bullish one. We also saw the same thing happen over here on the Russell 2000, and we've had a weekly bullish posture for the second day in a row on the Dow Jones Industrial Average. The NASDAQ composite stayed with a strongly bearish posture here today, naturally. Those other ones, it's a little surprising that they were able to get posture change on a day when we had such a big downdraft in the market. But remember, like every technical indicator, the intermediate line on the market forecast does have a delayed response, right? If you wanted an immediate reaction to today's activity, then you'd want to look at the red lines on the market forecast technical indicator, because those will basically react every single day with the markets. It's just hard to get any legitimate value out of that, because a lot of times you're not placing a trade for just one day. You're trying to get a sense of where the intermediate trend is at. Right now, I would say that the trends in general are still dicey at best, with all four of these charts still trading below their falling 30-day moving averages. So despite the weekly bullish posture presented by the market forecast technical indicator, where that green line briefly popped out of that lower reversal zone, I would say this is still a time to be very cautious in the market, because it seems like we are at a precarious moment where we could easily start breaking down below these support levels that we see here on the S&P 500 as well. So today, S&P 500 was down 1.16%. The Dow Jones was down 1.02%, the NASDAQ composite was down 1.47%, and the Russell 2000 was down 1.09%. Let's take a quick look here at our three green arrows setup. And as we pull that up, you can see that none of these four charts have a 3 green arrow signal or a 3 red arrow signal. All four of the charts have mixes of green and red arrows. It looks like the green arrows are coming in on the MACD histogram on all four of the charts, but on the other two indicators, the market forecast, or not the market forecast, but the moving average, and then the stochastic, we have red arrows on all four of the charts. So kind of similar, I guess, from that perspective right now. But it basically means we're in no man's land, right? We kind of trade wins for losses while we've been just going sideways in the market for the last couple of weeks. Eventually, we're going to break either up or down. And when that happens, of course, we'll alert you to it here in these videos. Lastly, let's go ahead and take a look here at our 1040 crossover method. And as you can see, we do have 3 out of the 4 charts with a bearish crossover, sometimes referred to as a death cross when we're looking at the 10-week moving average in orange versus the 40-week moving average in blue. The only exception to that is right here on the Dow Jones Industrial Average. It still managed to have its shorter-term line above its longer-term line, but the more selling pressure we have in the markets across the board, the greater the chance is that the Dow Jones will join these other 3 major indices from a longer-term perspective. Okay, so that's what I had for you here tonight. Nice and brief, to the point, nice and tight. And again, for all of you that prefer these tighter videos, don't click like on Twitter. For those of you that want to get me back on track with an hour-long video with a trade application example, then you'll want to make sure you take the 5 seconds out of your day to click like. So that's what I had for you. Appreciate you tuning in, and I look forward to serving you moving forward. Best of success with your trades and your investments. Goodbye for now.